Good day, viewers. Welcome to Business Television India. I'm Sriram Iyer. Over the last few weeks, the debate over RBI's inflation targeting has been hotting up. There are some, including the Chief Economic Advisor Arvind Subramanian, who thinks that the RBI is overestimating the threat of inflation. And there are those who believe RBI is better off siding with caution, because you can never downplay global risks. But now, after the OPEC has extended production cuts by 9 months, and even after that, market seems depressed, is it now safe to assume that the risk of a spike in oil prices has been averted? And if the answer is a yes, then is it now time for RBI to bring down its inflation target and ease policy stance? But before we do so, let's establish the grounds on which we are making this argument.
When a club has this many members, getting consensus isn't always easy. But just an hour into this OPEC meeting, and a delegates told Reuters they have, and the organisation will extend its reduced oil output by another 9 months.
The market is now well on its way toward rebalancing.
OPEC's previous cuts have helped push oil back above $50 a barrel this year, something some countries need more than others.
We'll look back in a few years and see that in 2015, 16, 17, oil prices made their bottom. It's a complicated bottom, up and down. I don't know, it'll probably go back under 50, maybe even under 30 again before the final bottom is made, but we are making a bottom, a complicated bottom.
Saudi needs a higher oil price because they want to maximise the valuation of the Aramco IPO next year.
But news this week that the US may sell half its reserves as it continues to produce large quantities of shale may undermine their efforts. Although some say that's not giving OPEC nations enough credit.
People who I've spoken to in the shale markets and the shale operation tend to suggest that while shale is obviously still a thorn in OPEC's side, that the production side of it is maybe getting towards some level of peak. So maybe OPEC actually has a fairly good read on what they can do with the shale outputs at the moment.
Markets had banked on the extension being more than 9 months. So despite early gains in the oil price on Thursday morning, it contracted slightly on the news with a dip in Brent crude.
So we heard Jim Rogers saying that oil prices are headed to $40 a barrel. Is that real? Let's take it across to Piyush Jain, our in-house expert. He's with us. Piyush, what is your view? What is the likely range for oil prices in the near term? And what will be the impact of that on India's inflation?
Well, if you look at the crude oil price, the range invariably has been between $45 and $60. Now, we know that US shale actually the output is very flexible. So as we start approaching $60, $57, $58, $58, the output actually starts increasing. We actually saw the rig count increase over the last few weeks when the prices actually were hovering around $55. So again, we basically have seen now that the prices, they have cooled off. The expectations of deeper cuts from OPEC, that actually have not fructified. And in response to that, actually prices have corrected now and actually basically trading around $50. So the range is actually there between 45 and 60. Some of the option writing is around $42 also. Some fears of oil slipping to $40, they remain alive. But yeah, broadly it's range bound primarily. Around 45, shale switches off. Around 55, 60, shale basically switches on. So it should be remaining in a range bound $40 to $60.
So oil will remain in $40 to $60, Piyush. But in terms of India's inflation impact, what are we going to look at? What are the weightages on the CPI and the WPI, and how will it affect India's inflation numbers?
So, well, in the new CPI index, the weightage has increased for the fuel components, which is petrol, diesel, crude oil. So which means if actually the fuel oil or the crude oil that actually corrects by roughly 5 to 10%, it would also imply that roughly around 0.2 to 0.4% reduction could happen in the headline CPI number also. And this actually would imply that in terms of WPI, the impact actually would be much more what you can see. And as you can see on the graphics, the fuel and power is at 13% component. Remember, crude oil 2.4%, mineral oil 7.9%. You are actually including the petrol, diesel also there, but you are also going to see coal, electricity, where actually the raw material is crude price, the transport, where again the crude oil basically is the input price. So if the price actually falls there, again the price actually basically falls in the category of fuel and power also. And similarly, if it goes up there also, which means if we combine everything, it becomes almost 20%, and that's a very significant component. So if the crude oil price goes down, it should be making making a very material impact on both the WPI indices and to a lesser, but still a very material impact on the CPI index.
So indeed, I mean, we are expecting crude oil prices to fall further, and which only means that the inflation will fall further. Let's look at the crude reality right now. The OPEC and allies have extended, the production cuts by 9 months, and despite that, the prices continue to fall. Global oil inventory is well above the OPEC target, and of course, the US oil production remains at a record high. Surplus oil will not be cleared up until the end of 2017. These are the broad pointers, the realities on which we are posing some big questions today. The big questions today that BTVI is asking is that OPEC has failed to prevent a fall in oil prices. So is it safe to assume that oil prices will remain capped for the next 1 year? And the question number 2 that we are asking is, given that oil prices are now capped, isn't inflation risks for India diluted? And therefore, the biggest question of all, shouldn't RBI lower inflation target and ease policy stance? So these are the big questions that we will be posing to our guests today, and we are being joined by Avtar Sandhu. He's Avtar Sandhu from Senior Commodity Manager at Phillip Futures. He's joining us from Singapore. We are also being joined by Aurobindo Gyan, Head of Research, Kotak Commodities. He's in the Mumbai studio with us. And Aditi Nair, Principal Economist from ICRA, is on the phone line from New Delhi. Thank you, ladies and gentlemen, for joining us on this big debate. The question here is, are oil prices headed decisively down? Let me take this to Aurobindo Gyan, who's here with us in the Mumbai studio. Aurobindo, do you believe that oil prices are going to be, going to fall to as low as $40? Is it possible?
Well, good afternoon. Well, actually, we have seen good amount of price correction post the decision is made that the production cut will continue to remain by 1.8 million barrels per day. And of course, before the meeting had happened, I think 3 to 4 weeks ago, we have been seeing crude oil prices rising from $46 to until $52, $53. So I would say the production cut news was perhaps mostly discounted in the market, and that is why we had seen the rally. And since post the meeting, there was no major differences in the meeting, which was consensus and rather was expected by the entire world. And post that, we have been seeing now crude oil prices been falling. So I think this price fall could continue. When we look at the supply side of the fact from the US, I think the market is still at the glut, and this production cut is definitely a viable scenario, and we should see prices perhaps in the short term to see some more correction downside. But then I would not exactly agree to the factor that price could come down to $40 at this moment. The current momentum could come down, could bring down the oil prices maybe another $3 to $4 from here. WTI crude oil per se, if I would say, it's trading around $48.5 to $49. We could see oil prices coming down to $46 as well. And if I talk about Brent crude oil, which is a premium of around $3 to $4 with the WTI, may also come down by another $3 to $4. But then in the short run, I would say the prices of crude oil prices should remain down, but then looking at a target of $40 might take quite ample time from here. And the very short term, we should see crude oil prices coming down to $46, as I said earlier.
So $45 actually is what Aurobindo is believing, and $40 seems to be a distant thought. But let me ask the same question to Avtar Sandhu. Avtar, now we know that how basically crude oil price has been shaping up, has been actually moving in the narrow range of 40 to 55 over the last few months. Do you believe that since we have not heard anything material from OPEC on any sort of more production cuts, in fact, they actually granted exemption status to Nigeria for not participating actually in the production cuts so far. Economy has been struggling, again similar sort of thing for Venezuela. Do you think that crude oil price basically could slip down much below than the levels which we have been used to seeing over the last 12 months?
Okay, if you look at the OPEC meeting itself, the hype there has been building up, had been for a 9-month cut and 1.8 million barrels a day off the markets. Okay, and the scenario was such that, okay, this was what the market was expecting, and the market had actually factored that in. Before the meeting itself, there were some who were saying that, okay, especially Russia, they may go for a year's cut and even a deeper cut per per day, but that did not materialize. So what had happened was a basic scenario, as you know, buy the rumor and sell the fact. And of course, once the WTI didn't exactly break above the strong resistance of $52 a barrel, there's quite a bit of profit taking. And now looking forward, what we have here is OPEC agreement, and judging from the last 6 months, we do have some discipline among OPEC producers, but what you have mentioned, what about Libya and Nigeria?
I have a question on the same on what you are saying. The question here is, as you are saying, nothing material came up from the meeting, but if we look in terms of peak season, we are seeing the inventories in US that has been falling. The gasoline inventory, like that could be on the other side, but the crude oil inventories, that has been falling. But still, in such a peak season, the driving season, we are seeing that the crude oil price, it doesn't have any sort of positive momentum. In fact, the prices, they have been trending between 40 and 52. So do you think that chances are very high as we move towards the second half of the fiscal year in India, that perhaps oil prices could start trading very weak around 45 or even below that?
Yes, we do see prices falling down, further down from here. The inventories have just started to taper off. That's in the US itself, but otherwise, if you look at it worldwide, the inventories are about 3 billion barrels, which is about 300,000 million barrels above the 5-year average. To bring it down, it will take some time. It will take deeper cuts and a longer period than agreed by OPEC to bring it down. And going forward, okay, we do have the driving season in the US, where will have good demand for the distillates, but otherwise, if you look at the production in the US itself, you will see that the rig count is increasing week by week. It's almost 404 rigs now as compared to a year ago.
Okay, I take your point, Mr. Sandhu. In fact, pretty much there is a consensus here. There's a market consensus, so to speak. I mean, Jim Rogers may be on the other extreme, expecting oil to fall to $40 a barrel. But most of them, nobody is expecting the prices to be higher than 45, 46 at best in the near term. So let me take this question to Aditi Nair from ICRA, the economist who's with us. Aditi, this is a debate that is only gaining steam here. Now, with this near certainty that oil prices are not going to cross the RBI's comfort level, the government is comfortable up to $60 a barrel, and therefore 45 is much lower than that. And over the next 6 to 9 months, if that is going to be the price level, isn't it time for RBI to ease its policy stance?
You know, it's not just going to be a matter of where crude oil prices are, but many other inflation risks as well, which are going to influence the MPC's stance as far as the inflation outlook is concerned. So definitely the fact that crude oil prices are likely to be softer than what the MPC would have expected even as early as April, that is one positive point. Having said that, I would like to point out that as far as the CPI is concerned, while there is a substantial weight of fuels and fares in terms of the transport and communication sub-index, a lot of the components that actually go into the CPI are fairly price inelastic and are really not very sensitive to changes in crude oil prices. For example, things like bus fares, taxi fares. Here we find that even LPG and kerosene, we don't tend to find that the price changes very sharply from month to month based on what the crude oil price movement is. And therefore, the impact on the CPI index is actually fairly limited as far as crude oil prices are concerned, and this is really by design. The WPI, of course, the transmission of price changes is very quick and very sharp, but that's really not the headline that the inflation anchor that the RBI is going to be looking at. Other than that, of course, we have seen a lot of other inflation risks seemingly easing over the last few weeks. The monsoon outlook appears to be better than what we initially thought in April. even as far as the GST is concerned, the government, or rather the GST Council, seems to have focused on minimizing the inflation risks, even if it's going to come at the cost of the central government's revenue buoyancy potentially in FY18. And therefore, overall, when we look at the inflation outlook, things seem better than what the MPC would have considered in April 2017. We've also had a lot of downside surprises on the CPI inflation numbers. The last 6 months in a row, for whatever reasons, including favorable base effects, we have had CPI inflation actually remaining lower than that 4% medium-term target that the MPC is looking at. Now, the outlook taking into account...
Aditi, I'm going to ask you this. The last time you were here with us on this show, just earlier this week, we were discussing an SBI report where SK Ghosh said that the inflation may fall to 2%. You weren't very sure at that point of time. You were suspect of that projection. Are you more certain now, or will you sort of tilt towards that estimate now?
Not 2%, but I do think that CPI inflation is going to trend between 3 to 4% in H1 FY18, and that is going to then ramp up fairly sharply and print between 4 and 5% for the rest of the year. So the issue is that we're still going to have this upward sloping inflation trajectory, which is in line with what the MPC had indicated earlier this year. But the entire trajectory is now likely to be lower than what we had assessed earlier.
Aditi, precisely my point. My point is that because we are now going to be lower on the chart, I mean, it is an upward-looking trajectory, but it will be lower on the chart. So therefore, your estimate earlier was an August-September change in policy stance. Will you sort of expect RBI to act sooner than that?
So the next policy is coming up in June, and the subsequent one after that will be in August. Our expectation is that there's going to be a significantly less hawkish tone coming from the MPC in the June policy, which is also just going to come a few days after we're going to get the revised GDP data, which is going to factor in the new WPI and the new IIP series. So I think that is also going to be something fairly significant for the economist community and, of course, the RBI to look at, the revised assessment of what GDP and GVA growth has been like these last few years. So I do expect that with the easing of the inflation concerns, the tone should be much less hawkish than what it was in April, particularly compared to the minutes of the MPC meeting. But I don't think that the stance is going to be changed back to accommodative just as yet. That could happen in August once the risks and the uncertainty related to the monsoon and the GST transition really become much clearer.
Stay on, Aditi. We'll again come back to you on the core inflation. Let me ask the question to Aurobindo now. Aurobindo, we talked about crude oil, where you're talking about $45. Now, what do you think about the gasoline, gas oil? Because again, petrol, diesel is actually what is being seen in terms of how the impact is being felt from the decrease in crude oil in terms of the retail market. So what's your opinion on the gasoline and gas oil, given we have seen the trend in US market? The gasoline inventory is actually last time it disappointed what the analysts were expecting. Do you think the gasoline and gas oil, both spreads, they can correct from here?
Well, actually, these are the derivatives of crude oil, so the price effect would be laggard. I think since crude oil prices have actually started to decline now, and I'm sure the effect would be seen in a couple of days' time from here. Like you have mentioned about gasoline, I'm sure we are seeing the stocks movement at US, and the gas oil price performance also we have been watching. So I think the price difference between price spread between gas oil and gasoline should narrow down a bit from here. Besides that, as I said earlier, since the effect has just started to see on the crude oil prices, we should see the effect on these derivatives eventually. And unlike the crude oil prices that we see on a day-on-day basis price movement, these prices are fixed on a 15 days or 20 days basis for the producers and consumers. So I think the prices are going to see its impact maybe in next 1 or 2 fortnight from here.
Sure. And I'm going to ask a similar sort of question to Avtar also. Avtar, in the derivative market, if you have been able to see, last time we saw a lot of positions were being written around $40, $42, and there was very high expectation that perhaps this time crude is going to slip to $40 or below that. What's your own assessment in terms of when you actually hear from the institutional investors or the hedge fund traders there? What is the sentiment around the crude oil price right now? Because the gasoline futures, they actually have not, the crash actually, they have slightly corrected. So do you think a similar sort of bearish sentiment is being seen around both gasoline and sort of the crude oil derivative positions?
Yeah, I wouldn't say it's an overly bearish outlook. What we are looking for is slightly lower trading range than before the OPEC meeting. Before that, we were looking at from $45 to $55 a barrel for the WTI. But now it's something like $42 to $42 to $52 a barrel for the WTI. My personal assessment is I'm looking at around $43, $44 a barrel as the strong support where prices will rebound once if it hits that.
Okay, so yeah, the prices may bounce back from the level of 45. That's what Avtar is saying. And of course, let me take this back to bring the discussion back to the inflation question, because you know, like we pointed out earlier in an earlier debate as well, these questions are being raised not just by you know, individual economists, up to the level of the chief economic advisor, who had earlier this week raised some questions saying that, you know, inflation is under control, core inflation is down 7 months in a row, and fiscal and monetary policy continue to be very tight. And I'm going to pose this question to Aditi once again. Aditi, the point is that if the headline inflation is not enough for the RBI to act, and it cites core inflation as a concern, even there the data is not supporting the kind of target that RBI has put for itself. Now the point is that the one important question is, if RBI were to lower its inflation target from say 4% to 3% or 3.5%, does that rule out a rate cut of sorts?
Look, I don't think that we're going to get a downward revision in the medium-term target of 4%. I think in any case, in terms of what has been enshrined, it is 4 plus minus 2, and I think that is what the RBI is going to work with, and they are going to be looking at whether we can get CPI inflation to remain durably around that 4% mark. So I would rule out a downward revision in the target itself to 3%, because that would really indicate a much tighter monetary policy scenario going forward. We do think that CPI inflation is going to rise back up above 4% as early as September or by October. So it's not as if these very low numbers are going to stay for a prolonged period of time. Even if we look at things like rural wage inflation, that's still well above 6% consistently over the last 6 months or so. So, you know, that is another factor that would impart stickiness overall to the inflation metrics. And the inflation expectations had risen in the March quarter, although I do think that the dip in food inflation is going to bring them down in the next survey reading. So overall, if we look at the RBI stance, I think it is going to soften. At the maximum at this point of time, we can expect 1 or 25 basis points rate cut, and obviously the jury is still out about what the timing of that is going to be. But I don't think that there is significant space for a sharp rate cut going forward, and particularly when we have the new data, even from the new IIP series, that's telling us that industrial growth wasn't as weak as what we thought. I'm not sure that it's going to be possible to really create an argument that the RBI should have cut faster, or that it should significantly cut rates now going forward.
Okay, that's a great respite for, I mean, from a market participant's point of view, who doesn't, follow the macroeconomic policy beyond the rate movements. Now, the fact that, now just a couple of weeks ago, people were discussing the possibility of a rate hike, and from there to say that, maybe there is one rate cut in the offing this year. And I know, Aditi, you have maintained this even before. You have said that, there will be one rate cut before the end of the this fiscal year. So now my question is, what role will the rupee play in this policy as well as crude inflation dynamics? How much stronger can it get, and if it does get, what will be the impact on inflation?
So as far as the rupee is concerned, we do think that it's going to remain in a range of 64 to 66 in the first half of this year, and that there would be some amount of pressure going forward that it could slip as much as 67 to 68 in the second half of the year. We're not really expecting it to strengthen further from the current levels in a very sustained manner. Of course, the rupee does tend to overshoot like other currencies, so we may see some interim strengthening. But overall, if we look at the trajectory for the rest of the year, I wouldn't expect it to strengthen in a sustained manner, particularly because at the end of the day, the inflation differentials, even though they now seem to be smaller than what we would have thought earlier, but they will persist, and a strong rupee at some point in time is going to start hurting our exports as well. Typically, that happens with a lag, and therefore, over the next few months, we could expect to see the export growth coming down very sharply, with not only the rupee strengthening, but the base effect going away, and the kind of rhetoric that we're seeing worldwide on protectionist and inward-looking policies. So the double-digit export growth that we've had for the last few months is unlikely to continue given this confluence of factors.
So let me ask Aurobindo another question on the crude oil. Aurobindo, if I actually ask you that the U.S. rig count basically has increased by almost 125% over the last 12 months, but if crude oil price, and as you were saying, $45, $50 basically is where actually you would be expecting the crude oil price to fall. But so suppose if the crude oil price remains in this range, do you expect that the rig count to actually go down again? And if the U.S. shale supply goes down, along with a 9-month extension of OPEC supply, is there a chance that the bearish sentiment on crude oil price could increase materially? Because again, at 45, 48, it won't be profitable for most of the U.S. shale producers.
From the US side, the shale gas productions are definitely is something there in the news for the last 1 year or so. And as you mentioned rightly about the rig count numbers, that indicates the production numbers are higher. And we are seeing the crude oil as well as other products like gasoline, distillates, and refinery utilization rates are also, if I look at it from the last 1 year perspective, the refinery utilization rate is also high. So that indicates that US production continues to be higher, and that is going to not change so immediately in the short run of perspective. So rather, I'm expecting the production numbers from the US should continue to remain high. That is one side of the market. Another side, because of supply glut, we have seen about the production cut now. So I think it is going to make a equilibrium in the market, and we should see that US production number continues to be higher. As far as prices goes, I'm sure we have been seeing a correction, and price could come down to $45 as I have mentioned earlier. So I'll stick on to my view on there, but then price coming down to $40 is something that perhaps I'm not looking at it in the short to medium term from here.
Thank you, Aurobindo. Thank you, Avtar. Thank you, Aditi. The AAA show that this was, Avtar, Aurobindo, and Aditi. Thank you so much for watching. And with that, it's a wrap on this special telecast. And the consensus on the panel is that oil is headed lower, and therefore RBI is likely to ease its policy stance. The inflation risk is going down. Aditi Nair saying that there is at least one rate cut in the offing in this year, and that's only good news for the markets, which is looking for additional liquidity at a time when when the Nifty and the Sensex are already at a record high. So let the celebrations continue. This is Sriram Iyer signing off on behalf of Piyush as well. Thank you so much for watching.